Something important is happening in the global financial system, and most people won't notice it until the effects show up in higher prices, higher interest rates, and shrinking purchasing power. Quietly, methodically, and without press conferences, China is changing how it stores its wealth. In just 1 month, Beijing dumped nearly $10 billion worth of US government bonds. At the same time, it resumed buying gold. That combination, selling treasuries while accumulating physical metal, is not random, and it's not short-term. It signals a deeper shift that could reshape the dollar's role in the world and affect everything from mortgage rates to retirement portfolios. This isn't about panic or predictions of an overnight collapse. It's about recognizing the direction of the tide before it becomes impossible to ignore. China's sale of $9.6 billion in US Treasuries marked its 9th consecutive month of reductions. That steady pace matters more than the headline number. China's total Treasury holdings now sit around $759 billion, the lowest level in 16 years. The last time holdings were this low, the world was just emerging from the 2008 financial crisis. This is not a fire sale. It's a controlled, deliberate exit. China remains one of the largest foreign creditors of the United States, and every move it makes sends ripples through global bond markets. When a buyer of that size steps back, the consequences reach far beyond trading desks. They show up in borrowing costs, government budgets, and household finances. Here's why this matters directly to Americans. The US government needs to refinance roughly $8 trillion in maturing debt this year. On top of that, it must issue at least $2 trillion more to cover ongoing deficits. When a major buyer like China reduces demand, yields rise. To attract new buyers, Washington has to offer higher interest rates. Higher yields mean higher interest costs. Last year alone, the US spent over $1 trillion just servicing its debt. That's more than the defense budget. And every small increase in rates adds hundreds of billions more over time. This creates a feedback loop. Higher rates increase deficits, which require more borrowing, which pushes rates even higher. And while China is reducing its exposure to US debt, it isn't moving into cash, it's moving into gold. After a brief pause, China's central bank resumed official gold purchases, adding 5 tons in November and another 5 tons shortly afterward. On paper, that may not seem dramatic, but history suggests those figures understate the true scale. Analysts estimate that China's real accumulation could be 10 to 15 times higher than what's officially reported, conducted through parallel channels and state-linked entities that don't show up in headline statistics. This isn't just China. Central banks around the world are doing the same thing. 2024 marked the 15th consecutive year of net gold buying by central banks. Total purchases exceeded 1,000 tons for the 3rd year in a row, more than double the historical average. Poland, India, Turkey, Hungary, and Kazakhstan have all accelerated their gold accumulation. Poland alone added around 90 tons in a single year. If you're finding this analysis useful so far, take a moment to like the video and share it with someone who follows global economics. It really helps get this information in front of more people. So why gold? And why now? Gold carries no counterparty risk. It can't be frozen, sanctioned, or devalued by a foreign government. After the freezing of Russia's dollar reserves, central banks around the world got a clear message. Reserves held in someone else's currency are only safe until they aren't. Gold has become not just a hedge, but a form of financial sovereignty. China's treasury sales also appear to be strategically timed. Many occur during periods when US markets are less liquid, amplifying their impact. Fewer buyers mean more volatility. Rising yields tighten financial conditions across the economy, affecting everything from corporate debt to consumer credit. This creates a dangerous spiral. Selling pushes rates higher. Higher rates worsen deficits. Larger deficits require more borrowing. More borrowing pressures rates again. And as this cycle accelerates, confidence begins to erode, not all at once, but gradually. At this point, an important question emerges. Is this just prudent reserve management, or something more deliberate? Increasingly, it looks like a form of financial signaling. By reducing exposure to US debt, China is demonstrating that the dollar is no longer the only game in town, and that reliance on it comes with geopolitical risk. Nowhere is this shift more visible than in global gold markets. The Shanghai Gold Exchange has become a critical hub, with massive volumes of physical gold moving through its vaults. What's especially notable is that many of these transactions are priced in renminbi, not dollars. Western buyers seeking physical metal are increasingly settling trades in Chinese currency, even as they attempt to hedge against dollar weakness. That irony speaks volumes. We've seen moments like this before. In the early 1970s, France challenged the dollar's gold backing, triggering the collapse of the Bretton Woods system. Back then, the dollar survived because there were no viable alternatives. Europe was rebuilding, the Soviet system was failing, and China had not yet emerged as an economic power. Today, the landscape is entirely different. China is the world's manufacturing hub and the primary trading partner for dozens of countries. It has built alternative payment systems, currency swap lines, and commodity supply chains that function outside the dollar system. China's cross-border interbank payment system, known as CIAPS, processed over $24 trillion worth of transactions last year, a sharp increase from the year before. Trade between China and Russia is now largely settled in local currencies. India is purchasing energy using rupees. Brazil and China conduct bilateral trade without touching the dollar. These aren't experiments, they're operational systems. What do you think happens if more countries decide the risk of holding dollars outweighs the convenience? Drop your thoughts in the comments. I'm genuinely interested in how you see this playing out. The expansion of the BRICS bloc reinforces this trend. With new members and partners representing over half the world's population, the group is building a parallel financial architecture. Its development bank lends in local currencies, bypassing traditional Western institutions and their policy conditions. It's slow, but it's steady, and that's what makes it powerful. Meanwhile, physical precious metals markets are flashing warning signs. Silver inventories in Shanghai have fallen to their lowest levels in a decade. Lease rates in London have surged, indicating real shortages rather than paper market noise. Silver isn't just an investment metal. It's critical for electronics, solar panels, electric vehicles, and defense systems. And much of the world's refining capacity is concentrated in China. That creates leverage. The US has classified silver as a critical mineral, yet supply chains remain exposed. As inventories tighten, prices disconnect from futures markets. Physical premiums in Asia have reached levels rarely seen before. When demand for delivery overwhelms paper claims, pricing mechanisms break down. This is happening as the United States runs massive deficits during economic expansion, a historically unusual and risky position. Rising rates threaten to crowd out spending, weaken growth, and strain government finances further. Even close allies are diversifying. Poland and India's gold accumulation isn't political, it's precautionary. No central banker wants to be the last one holding depreciating reserves. Each move away from the dollar encourages the next. Momentum builds quietly, until suddenly it becomes obvious to everyone. This doesn't mean the dollar disappears tomorrow. But dominance doesn't end in dramatic collapses. It erodes through alternatives, diversification, and loss of trust. What we're seeing now is not chaos, it's coordination. For investors, policymakers, and everyday citizens, the real question isn't whether change is coming, but how prepared we are for it. Monetary regimes last until they don't, and history rewards those who recognize transitions early. The world is moving toward a multipolar financial system, grounded less in promises and more in tangible assets and diversified settlement networks. That shift is already underway. If you found value in this breakdown, make sure to like the video, subscribe to the channel, and ring the notification bell so you don't miss future updates. Thanks for watching. And as always, stay informed, because in times like these, understanding the system is the first step toward protecting yourself.